Hi, this is Merrill Jenks with the Big Helper Real Estate Group, and today I want to talk to you about a really important topic, and it's probably one that you maybe haven't spent very much time thinking about or even realize that it exists, and it is capital gains tax as it relates to real estate. Okay, there's other capital gains tax that you can have with the stock market and other things like that, but today I'm focusing specifically on real estate. Now, if you own your primary residence, and this is where a lot of people get really hung up. Actually, I should probably preface and say I am not an accountant and this is not tax advice. However, I deal with people all the time who are, potentially going to need to pay capital gains tax, and I can kind of tell them sort of the basics of what the rules are and then advise them to talk to an accountant. So in today's video, I just want to talk to you about some of those basic principles. So if you own a primary residence and you eventually sell that primary residence, as long as it was your primary residence for at least 2 out of the last 5 years, then you can have a gain of up to $250,000 as an individual that is not taxable by, from a capital gains standpoint. And if you're married, you can have a gain of up to $500,000 that is not taxable. Now, I get a lot of people who are very, very confused about how that capital gain is calculated. And so just a kind of really basic breakdown, it has nothing to do with how much you owe on the house and what your mortgage is. What it has to do with is how much profit did you make between the sales price and the purchase price. And if you had a big gain, you can also subtract your closing costs when you bought it, the closing costs when you sell it, and improvements that you made to the house. So if you put in a pool and you spent $50,000 on that, you can subtract that from your gain. So here's a basic example. Let's just make it really simple, pretend like you don't have any fees wrapped up into this. You buy a house for $500,000, and however many years later, you sell it for $1 million, okay? And let's just pretend that you didn't do any improvements to it and you didn't have any closing costs when you bought it or you sold it, then that's a $500,000 gain. Now, if you are a single person in that situation and it was your primary residence, $250,000 of that is not gonna be taxed with a capital gains tax, but $250,000 of it is. And if you're married, you had that $500,000 gain and you don't have to pay capital gains tax on any of that. But once your gain exceeds those numbers, now suddenly the amount above those numbers, you are going to have to pay a capital gains tax on it when you go and sell the house. The amount of the capital gains tax depends on how much your ordinary income is, and it's usually, for most people, going to be 15 or 20%. So if you had a $100,000 gain on a property that was above, maybe it wasn't your primary residence, or you made $600,000, $100,000 above, you're paying an extra $15,000 or $20,000 in taxes when you go to sell that house. Now, the reason why I bring all of this up is lately the housing market has been crazy and people have been buying houses, and a year later their house is worth $100,000 more than they paid for it. And they're like, gosh, we have all this equity in our house, why don't we sell it? And so a lot of people are turning around and they want to go sell that house. And I met with multiple sellers recently, but one in particular, he found this home that he really, really loved and thought he wanted to sell his house, and he had only been in the house for a year. And so I explained to him, hey, because it hasn't been your primary residence for 2 out of the last 5 years, when you go to sell this house, you're going to have to pay this really heavy capital gains tax. It's really going to eat into your profits, which is going to affect how well you can afford this other house that you really want to buy. But if you just wait until you've been in the house for 2 years, then you guys are married, you have up to $500,000 that you can make on this property without having to pay the capital gains. So I don't want to get too much into the weeds, but basically this particular client decided, yeah, you know what? It really makes sense for us to wait. It's going to cost us more than $20,000 in taxes to sell our house now. We can just wait 8 more months, and then we get to keep that $20,000 and put that towards the next house. And I bring this up because I think that there are some agents out there who would just be so excited to get your listing, and obviously it's not their job to give tax advice, so they just sign the listing, get you signed, take their commission, and then suddenly you get the tax bill for it. And when you work with us, we're really trying hard to help you, again, not accountants, but we're really trying hard to make sure that you think about all those aspects. We're not interested in a fast sale or a quick commission. We're interested in being your real estate partners for life. And so we want to make sure that you're considering all of those aspects. So I hope you found this a little bit helpful. If you have any questions about capital gains, if it's a simple question, I might be able to help. If it's a more complicated question, I highly recommend that you speak with an accountant. Thank you.